Well, the S&P 500 is hanging near its all-time high, but stocks are faltering as Micron shares saw some pressure today. For more on this, we're joined by Jack Ablin, founding partner and chief investment officer at Cresset Capital. Jack, great to have you with us. As we get to the end of the first half of the year, there seem to be increasing predictions in your world, the world of strategists and portfolio managers, that the big run in mega cap U.S. tech names may be getting stretched. Do you agree?
Yeah, I do, Paul. We published a piece yesterday that looked at, for example, comparing NVIDIA today versus Oracle and versus Cisco during the internet boom and subsequent bust. What we learned was that we don't believe that NVIDIA is trading at even a similar valuation as, let's say, Cisco was in 1999, 2000. But it does seem to parallel what we'll call the picks and shovels of that theme. Cisco in the case of internet, NVIDIA in the case of AI.
Do you see value in non-North American stocks or non-U.S. stocks? I know you've done some work looking at the forward price earnings multiples on the S&P 500 versus a key measure of non-U.S. stocks.
Yeah, and from that, I would say no. It's interesting to note on the surface, if you just compare forward PE ratios of international developed stocks against the S&P 500, international developed is trading at would appear to be a massive discount to the S&P. The problem is when you move from the S&P into, let's say, Europe, you end up taking your tech exposure down by 2/3. And increase your financial exposure and consumer exposure up by 1/3. And so when you normalize for the sector weightings, what we find is that international developed stocks actually trading at a forward PE of 23 times, while the S&P is only at 21 times. Still stretched, but not as much as let's say, Europe.
Back to the U.S., you say your expectation is that dividend growers will do well in the second half of this year.
Yeah, so what we expect is as we start to migrate into the second half of the year, that the prospects of Fed tightening will start to come closer into focus. You know, obviously there's some Fed governors that are off the table, completely for rate cuts this year. But I would say consensus is probably somewhere between 1 and 2 cuts later this year. And as we start migrating toward the back half of the year, those targets will start to come closer to focus. And we do think a broadening will ensue. And so we do like quality companies, but we like companies that have persistent dividend growth over time.
How many rate cuts do you think the market needs to either see or be very confident are coming in the future before dividend payers start to get a lift?
Yeah, I'm going to say we're going to need to see at least one, because we know that once the Fed does start cutting, they're not one and done. This is really the first of a series of rate cuts that we expect. And if you consider that over the long period of time that the overnight rate tends to track real GDP, then really the right rate level for the U.S. should probably be closer to 2.5%, certainly not 5.5%.
Okay, tonight a big debate happens. It is perhaps it kicks off the U.S. presidential race in earnest. It's coming earlier than usual. It's the debate between President Biden and former President Donald Trump. What are your thoughts on the U.S. election campaign, the election outcome, and the markets?
Sure. So, we do expect some volatility, although if you really drill down, the underlying policies of both candidates are pretty widely known. We've lived through both presidents. But what's troubling to me is that neither candidate is really running on any kind of platform of fiscal responsibility. So both candidates have run up government deficits at unprecedented levels, leaving us now with an interest rate bill that's rivaling what we're spending in defense. So I'd love to hear some adult talk about reconciling our fiscal situation. I don't think we're going to hear that tonight.
Okay, let's move on to some of your stock picks. And again, one of Jack's big themes is dividend growth in the current market environment, a market environment where the Fed is expected to reduce its benchmark interest rate. One of your picks, McDonald's. And
Sure, let me put on my thinking cap, Paul, before I go into my dividend stocks. As you know, I'm down here in West Palm Beach. So, McDonald's. Great quality company, dividend yield of 2.6%. We expect that dividend to grow by 10% per year over the next 3 years.
Okay.
Next stock, ADP, automatic data processing, high quality company again, 2.3% dividend yield with expected dividend growth well over the rate of inflation at 7.4%. And then lastly, General Dynamics, certainly in the mix of things with hostilities globally, high quality company also, 1.9% dividend yield, and we expect that dividend to grow at an annualized 7.2% per year for the next 3 years.
Very, very quickly, because we're out of time, how do you arrive at your forecast for dividend growth at these companies?
Sure. So we're looking at free cash flow to enterprise value, and we just are holding a constant payout ratio. And it's a pretty simple calculation.